Yes, yesterday, we have done inventory valuation, learned both the methods of valuing inventory, that is FIFO method and average cost method, that is weighted average cost method. Both in situations where it was valued periodically at the end of that particular period, the valuation is done, or it's an ongoing, perpetual, or continuous valuation. In that case, how to value the inventory is what we have learned yesterday. Apart from that, we also have started with property, plant, and equipment. How are um, how are the accounting entries recorded with respect to property, plant, and equipment? That is at the time of purchase, what journal entries would be written. But before that, we also have understood the differences between capital expenditure and revenue expenditure. How the um, purchase of fixed asset is recorded in the books of accounts. What forms part of the cost of asset? With the journal entry for recording the cost of the asset. Then we've learned about, we've just started, I think we've just started with depreciation. No, we did discuss about, sorry. We did discuss about depreciation also. What is depreciation? Um, See, the definition that is given according to IAS 16 says that is the systematic allocation of the depreciable amount over its useful life. So the meaning of depreciation, the reason why depreciation is provided, we did understand. According to your syllabus, there are two methods, but otherwise there are other methods also. Straight line method, which provides depreciation throughout the life of the asset evenly. The same amount would be there each period. But in case of reducing balance depreciation method, see, whatever is the carrying value, on the carrying value, the percentage of depreciation is applied. Okay, then the journal entries, I did explain to you the concept of accumulated depreciation. And then when it is sold, um, if the sale value matches with the carrying value, then there is no profit, no loss. But then if it is anything different than that, then we realize that there is a loss or gain. So that how do we understand? If the sale value exceeds the carrying value, it is a gain. They are supposed to realize the same carrying value, but if they realize more than that, it is a gain. Otherwise, it is a loss. Now, let's start with revaluation of non-current assets. Today, let's start with this topic, revaluation of non-current assets. Assets are accounted at the cost value. When an asset is purchased, asset is valued at the cost value. After that, periodically, yearly, whatever is the amount of depreciation that accumulates, that is accounted. So at the end of the period, we understand what is the carrying value. Since at the time of purchase, there is the method of depreciation is adopted, and until the end of the life of the asset, it is the same way in which it is provided, and we have at the end of the life of the asset, it is disposed of. But then, so at any point of time, the carrying value, is it the actual value that can be realized? Carrying value is the value which would be realized if it is sold. Okay. So, I mean, is that the actual amount which can be realized or not? Now, that's a question mark. See, at the time of purchase, when they decide on the depreciation method and depreciation is provided periodically for some time, so the way it is accounted in the books of accounts, it need not be the real picture. See, when the asset is sold, it need not be that the same amount of carrying value will be realized. It may be different because there are so many fluctuations. The assets are sometimes appreciated. The market value rises very high in situations like properties. We see that there is appreciation, the market value increases, it becomes very high. or in case of others like plant, equipment and all, because of technological changes, there could be obsoleteness, or they may become outdated. Okay, so when the assets are to be disposed of, this is not the same value that would be realized as it is accounted in the books of accounts. So then, see, the books of accounts um, show some value which is not the value that can be realized because of so many reasons. In that case, revaluation of the non-current assets takes place. So revaluation of non-current assets, what does it mean? The business entities may choose to reflect the current value of an asset in the statement of financial position. This is known as revaluing the assets. So periodically, then they think about see the principles of accounting. One of the concepts is that the asset should be accounted at the cost value. But the cost value, if it is accounted, the book value of the asset is not the value that reflects the market value. Fair market value may be something else, and the book value is something else. Therefore, there is a need to adjust the book values. When that adjustment is done, um, then we call that to be as revaluation of the assets. This is known as revaluing the asset. If done, it is normally be for land and buildings rather than other items of property, plant and equipment. Revaluing them and showing them at the fair market value. See, when the value appreciates, so that appreciated or increased value will be reflected in the books of accounts. Then we see that the other assets, other non-current assets like property, plant and equipment also, we don't see that the value increases, but rather it decreases because of technological changes. The value of these things, either they are the same or they would be decreasing. Okay, so every version of that particular product or that particular piece of equipment, plant, machinery, we would see that an advanced version comes. So the old version, sometimes it may no longer be existing. There may not be any such type of or such version of the product produced by the companies. So on that note, there may not be anything that is realized. So what do we do? That we will be seeing. That is not called as revaluation, but then that is called as impairment. Right now, the revaluation of the assets is taken up for the assets that appreciate in value. So when the value appreciates, if the business entity chooses to adjust it to the fair market value, the revaluation is taken up. The book value is adjusted according to the market value, and that process is called as revaluation of non-current assets. Okay, so revaluation of non-current assets is a gain, it's a benefit for the business. So because the value of the assets is increasing, okay, if the value of the assets is increasing, so that is a revaluation surplus. Okay, revaluation surplus is equal to the amount of the revalued amount, the difference between the revalued amount and the non-current asset. I think it is uh, so this is a gain, revalued surplus, that is accounted after adjusting the book value of the asset according to the market value. Sorry, CA is cost of the asset. Sorry about that. Um, so how is the entries done in the books of accounts? Revaluation surplus is equal to revalued amount minus the cost of the asset. So for a non-depreciated asset, non-current asset at the cost value to the revaluation surplus. There was no depreciation that was provided. So the asset appears in the books of accounts at the cost value. In that case, any amount of surplus that is realized because of appreciation in the value of the asset, the journal entry would be the non-current asset value is increased as against a revaluation surplus. So that's the journal entry. For a depreciated asset, if the asset is depreciated, in that case, the cost of the asset is now basically, because the cost of the asset keeps reducing by the amount of depreciation, and this depreciation amount is all shown in the form of accumulated depreciation. So the asset value is split between, the cost of the asset is split between accumulated depreciation, okay, and the carrying value of the asset. But the carrying value of the asset is to be shown. Carrying value of the asset is not shown in the books of accounts. Carrying value or the book or the written down value is not shown in the books of accounts. On one side of the balance sheet, on the asset side, the original cost is shown as it is, and on the other side of the balance sheet, that is on the liability side, we have the accumulated depreciation. Okay, so the cost amount and the accumulated depreciation amount, now when they are adjusted, we would have the carrying value or the written down value of the asset. So in that case, for a depreciated asset, the journal entry would be, it is the revaluation surplus which is credited. Okay, the asset is now basically made up of two parts: accumulated depreciation and non-current asset. So non-current asset would be as it is, it would be at the original cost, but that has to be increased. The by the revaluation surplus amount, that amount of the that will be added to the original cost of the asset, non-current asset, will be increased. Here we just have, because there's no amount of depreciation there, so whatever is the cost value, the surplus amount is added to that and it is increased by that amount. Here it is, see, we have the depreciation also charged, then we have the non-current asset. So the surplus value gets added to the non-current asset. Okay, so depreciation to date balancing figure and revaluation surplus if we prepare the account. How to calculate depreciation on revalued assets? The asset is revalued to adjust it according to the fair market value when it is revalued. After that, how is depreciation calculated? Okay, so calculate the depreciation charge on the same basis as usual, using the new revalued amount. So whether it is straight line method or written down value method. Now it is a new base. Take the new base and calculate the depreciation amount. The accounting treatment would be the same. Depreciation expenses to accumulated depreciation account. The accounting treatment would be the same, but only thing is that the base will change. The asset is now at a new value. It is not the original cost which was incurred to acquire the asset, but now it is a revalued new amount. So based on that new amount, the percentage of depreciation according to straight line method or written down value method will be applied, and the new amount of depreciation will be calculated. Treatment is the same. Depreciation expenses account data to accumulated depreciation account. There is a new account, that is, see, when the asset is purchased itself, there is a new account called as an accumulated depreciation account created. So the amount of depreciation will be charged to accumulated depreciation account. Okay. So in addition, a business entity can choose to make an annual transfer of excess depreciation as follows. They can also transfer that to revaluation surplus. So adjusted account, already there is a new account which is created called as revaluation surplus because there is a gain that is realized. So there is a gain that is realized, revaluation surplus that is realized. So alternative method is the same amount of depreciation as usual will be charged on the old asset. Now the new value which is increased on that any amount of depreciation will be adjusted again. That is, to that extent, revaluation surplus will be deducted. So revaluation surplus is a gain. So gain, it is part of the benefit the owner enjoys. That is, it is part of the retained earnings. So now the adjustment would be that the revaluation amount of revaluation surplus on the new asset, that would be either charged to retained earnings or it is appearing in the books of accounts as a revaluation surplus. Any excess amount of depreciation will be deducted from revaluation surplus. Too complicated? Is it easy? Difficult? I know it's, I don't know. I myself I'm feeling that it. Are you able to follow? No response is coming.
It's a little bit difficult, ma'am. Can you
No, it
repeat
is
it?
difficult. Very
Repeat this
difficult.
topic.
Not little bit difficult. It is very difficult. I thought I'll stop at one. I mean, see, in the balance sheet, we would have the non-current assets. Non-current assets appear at the original cost. So non-current asset would be there at the original cost. Any amount of depreciation that is charged on the non-current asset appears on the liability side as accumulated depreciation account. But the, see, at the time of sale, the difference between these two, that is non-current assets minus the total amount of depreciation, we call that as written down value or the carrying value of the asset. So written down value is the value which should be realized on sale. That is the meaning what it conveys. We also call it as carrying value of the asset. But all non-current assets may not realize the same amount of written down value. Most of the time it would not be, because there are so many fluctuations that happen with respect to non-current assets in the market. For certain assets, the value keeps increasing, like property. All properties we see most of the time, the value appreciates, like land, buildings, etc. They appreciate. For other assets, like plant, machinery, equipment, etc., the value decreases. So whenever the value increases, the business can choose to adjust the non-current assets according to the market value. So for that, there is a revaluation process that is taken up. Compare what is the original cost and the market value. Now that the market value is definitely higher than the original cost, that whatever is the difference, now if it has to be adjusted, if this non-current asset has to be increased according to the market value, in that case they would be realizing a surplus. Okay, all of a sudden we see that the asset side increases. If the asset side increases, then that would be a mismatch between assets and liabilities. If the asset is increasing, that is a benefit to the business. Now that benefit will be accounted as the revaluation surplus. That, see, any surplus, any profit, all that belongs to the owner. So it becomes a part of the equity or retained earnings. So now the increased non-current asset, the increased revaluation surplus will match on, will tally on both the sides. So the balance sheet on both the sides will match with each other, because whatever was the increase here on account of appreciation in the value is also adjusted here on the liability side as revaluation surplus. What journal entry would we write if there is a revaluation? See, assets, some of the assets, there is no amount of depreciation provided. They appear there at, at their original cost in the books of account. So if at all, if there is no amount of depreciation, then the journal entry would be just to increase the non-current assets by the revalued amount and the revaluation surplus. But let's say if there is already depreciation provided, accumulated depreciation provided, so the journal entry would have the amount of depreciation accumulated until that date. Okay, then the increase in the non-current asset. Okay, see, when there is a depreciation, the original cost of the asset is split into two parts. The original See, the original cost of the asset is now split into two parts. One is accumulated depreciation, one is the written down value. See, this is accumulated depreciation, and we have the carrying value of the business, carrying value of the asset. So carrying value of the asset, it is split into two parts. Now both of them would appear in the debit side. It's the sum total of these two things together is the asset. So when the asset is revalued, so that difference, whatever is the revaluation surplus, here we just added it to the non-current asset, that amount of revaluation surplus, but we bring into the picture even the accumulated depreciation. See, whatever is the revaluation surplus, it would be added here to the carrying value of the asset. So that's the journal entry which is passed when the assets are revalued, adjusted according to the market value. Because otherwise the cost concept says that all transactions should be accounted at the original cost, not at the market value, subject to any amount of appreciation or depreciation. But this amount of appreciation which is taken up may not go according to the price increases in the market. Therefore, periodically revaluation is also taken up. See, on account of revaluation, it's a gain, it's a surplus that they have realized. So how do we write the journal entries is what we've looked into. Okay, so that's how revaluation happens. So when depreciation of now the asset is not the old asset, it is a new asset, it is a revalued asset. Now how is depreciation calculated? Take the base as the new value. See, earlier if it was 50,000, if the value of the asset was 50,000, on revaluation if it stands at 60,000, take the base as 60,000, the rest of it would be the same. On now henceforth, the percentage of depreciation, if it is straight line method, will be calculated on 60,000. Then written down value method, from 60,000 they start writing down the value of the asset and then provide the depreciation. Method of depreciation would be the same. It is only that the original base amount of the asset will change. That is all what how depreciation will be calculated. Now, any amount of surplus which is accounted in the books of accounts belongs to the owners. So either you show it separately as a revaluation surplus, or you transfer the entire amount to an account called as retained earnings. Retained earnings, the meaning of it is profits which are not distributed to the shareholders, but they are retained in the business to meet any future purpose. So instead of keeping it in the account as revaluation surplus, it can also be transferred to or club it with the retained earnings balance. So that is the meaning until now, what we've looked into. Did you understand it a little better than the previous one?
Yes, ma'am.
How to account for disposal of a revalued asset? If the asset is revalued and it is sold, calculation of gain or loss on disposal on as normal using. So how do we realize? I think I did mention yesterday, whenever asset is disposed of, if there is an asset account, on the debit side it would be the original cost. The original cost, now it would be the revalued cost of the asset, and after that the accumulated.
Yes, ma'am.
Yes, ma'am.
Ma'am, how often does an asset get revalued?
Yearly it would be done, not in between that. Yearly it would be done. It would be the same case with if it depreciates, we call that to be as impairment. That is also done yearly. It is not very frequently done during the year. It would be done yearly once.
Ma'am, if it's done yearly once, do we always have to prepare an revaluation surplus account or something like that?
I didn't get you. If we do it once,
No, I mean, if we do it yearly, if an
Mhm.
asset is revalued yearly, and let's
Mhm.
say that every year it's valued at a different amount,
Hmm.
then do we have to do this revaluation surplus?
Every time it is revalued, every time the adjustments have to be done. So the increase in the non-current asset will be charged to revaluation surplus. Either you have it as revaluation surplus account all the time maintained, or that is all transferred to the retained earnings. So every time the adjustment would be done.
Okay.
See, on disposal, see, original cost is there on the debit side, that's the beginning balance of the asset. Then accumulated depreciation, whatever got accumulated till the date of disposal, take that amount and deduct it. So the difference between these two is the value that should be realized. Then if the sale value, the cash amount that is realized on sale, cash or bank or receivables or whatever is that, whatever um, is going to be received, if it matches the carrying value, then fine, there is no profit, no loss. Otherwise, see, if this cash amount is anything less than the difference in this, there would be a loss if any, or it also, if the amount which is going to be realized is greater than the difference, then it is a gain. Either a loss or a gain is possible to happen. So calculate gain or loss on disposal on as normal using the revalued amount. Only difference is it will now not be the original cost, but this will be a revalued cost. So revalued asset, since the adjustment is already made, the original cost is inflated to the revalued amount. So revalued amount at the beginning of the period, accumulated depreciation, check the amount that is realized. If it is equal, fine. If it is less, it's a loss. If it is more than the carrying value, it is a gain. The way we treat the disposal transaction, same is the way it would be treated on as normal using the revalued amount of the asset rather than original cost, the account for the gain or loss in the statement of profit and loss. Apart from that, in addition, transfer the balance on revaluation surplus to retained earnings account. So either you maintain it as a revaluation surplus or transfer that entire amount to retained earnings. See, the definition of accounting, when we see the definition of accounting, it talks about, it says that it's an art of recording, classifying, summarizing transactions that are measurable in terms of money. So only the financial terms appear in the books of accounts with respect to property, plant and equipment. For that matter, any item, any element of the financial statements, the monetary value appears in the financial statements. We don't see any other details apart from that. We just see what is the cost of the asset, we see the amount of depreciation, we see the amount of loss, if at all, if there is anything incurred, or the amount of gain. But other details are not provided, like the when the asset was purchased, what is the method of depreciation that was adopted, was that changed anytime? Of course, that is also allowed, that depreciation after a while the method can be changed if it is needed. With a justification, it can be changed. So those kind of additional details are not part of the financial statements. So no additional details about any element of the financial statements is included in the financial statements. But see, at the very first class when we started, who are the users of financial statement? There are many users of financial statements. Their interest lies with the information that is provided by the business entity. So they want to understand more details about all the elements of the financial statement. So those details which are not included about the property, plant and equipment (PPE) should be included in notes to financial statement, or additional details should also be provided. If we only have the total original cost of the asset, in between, if at all, if they added anything and what method of depreciation provided, etc., such details are not provided. So then the other details should be included in notes to financial statement. Now, statement of financial position has the aggregate carrying value of property, plant and equipment disclosed on the face of the statement of financial position. Profit and loss includes the any kind of depreciation charges, including relevant expenses in the profit and loss account. Any revaluation in the year is included within other comprehensive income. Other comprehensive income is, see, the income statement. If there is an income statement, it's a vertical statement. So income statement will have the regular business, see, the continuing business, the main operations of the business, continuing operations, whatever take place during the year. Of course, there is no heading as such, but the regular activities that are taken up, that is, start with sales. Sales minus cost of goods sold is gross profit, minus that operating expenses. Everything related to the business which is carried on during that year, will, all those transactions will appear here. Then we have the net profit that is realized. Apart from that, any additional transactions that are taken up, we would see them accounted as other comprehensive income. The heading would be as other comprehensive income. Because we don't follow this method, we don't even find this term called as comprehensive income anywhere in our Indian textbooks and all. Okay, so internationally, this is the method that is followed. So other comprehensive income, which is not a regular part of their normal business. The revaluation is not part of the trading activity. The main activity, the main operation of the business is buying and selling. Revaluation doesn't fit into the buying and selling part of it. It is irregular in nature. It is not part of the operating activities. Therefore, this transaction, the gain that is realized, forms part of other comprehensive income. After that, if suppose any business which was discontinued earlier, if there is any transaction that comes up from the discontinued business, also appears here in the income statement. Of course, when it comes, when anything like that which comes up, we can take it up. But this revaluation surplus, whatever is realized, would not be part of the operating activities, but it would be part of the non-operating activities, which is recorded under the heading called as other comprehensive income. Any revaluation in the year is included within other comprehensive income. That is also part of the income statement, but distinction is made separately. It is accounted. The net profit from the operations is accounted. After that, below that, there is a heading called as other comprehensive income that will be accounted. So that is also the profit of the business, but separated, distinguished, and then while disclosing these details, it is separated and disclosed. Any other additional details would appear in notes to the financial statement, like the method of depreciation, if at all, if they've made any other changes in terms of providing depreciation, disclosure of movements in cost, that is carrying amount and accumulated depreciation in the year, any changes, that is additional assets were purchased, and those details about the additional assets, details about the assets that were sold, etc. So those additional details which could not be included in the financial statements are to be included in notes to financial statement. So financial statements is a summary statement. These are summary statements. We just see that in few pages, the summary of all the transactions are presented in the financial statements. Because there are many uses of financial statements, so the business entity chooses to provide all possible details to the users of the financial statement. Therefore, every year they come out with a report called as an annual report of the company. Annual report is a very big volume. Randomly, you can download any companies, so real time, any company you choose and download the annual report. The recent year would be the year ending. If it is an Indian company, it would be the year ending 31st March 2022. So for that year 21-22, you just try and see that, download a particular company. If it is an international company, whenever that year ends, check that the dates and then try downloading that. So just go through that annual report, and there are so many details included in that uh, annual report, more than what the financial statements depict. More than that, a whole lot of information is included in the annual reports. Now all companies do put in effort to provide all those details, so the additional notes that are prepared. There is a concept called as integrated reporting. I'm not sure whether it is part of this paper. If it is there, I will talk about what is integrated reporting. Additional information is provided in the reports for the benefit of the users of the financial statement. These stakeholders, see, they are keen on getting this information. Based on that, they can take the decisions for the future. So the decisions that they have to take is all dependent on the information provided by the business entity. Financial statements only provide the summary. Entire thing, see, full disclosure would be there, but that is in a summarized form. So summarized form may not be very useful for many users. So every detail relating to elements of the financial statement is in detail included in notes to financial statement, or we also call annual reports provide many more details. So try it out for some company. Randomly you choose some company and download it and see, they are all downloadable in PDF format. Okay, try and see. Okay, now so we've done with current assets. In case of current assets, we have discussed about receivables. If the assets are, if the goods are sold on credit basis, and if there is a credit period extended to the customers, in terms of attracting them in to pay to make them pay the amount, receive the amount, how cash discount is given. So that adjustment we have discussed. That was with respect to receivables. Another item, inventory. We have yesterday we've learned about how to value the inventory. See, in the balance sheet, we see that on the asset side there are assets that are classified broadly. If in the case assets have to be broadly classified, we see that they are classified as current assets. I don't know whether you know the meaning of current assets and non-current assets. I will talk about that. And they are also called, they broadly classified as current assets and non-current assets. Non-current assets, the common term which we are used to is, we talk about that as fixed assets. What are current assets? Do you know about what's the meaning of current assets? Any one of you? I will anyway talk about that.
Yes, ma'am.
Okay. What are current assets?
Ma'am, kind
The
of
assets that are
assets are
currently
those which
present
can
within
be
your
turned into
organization.
profit in 1 year.
Those that can be converted, liquidated into cash in a period of
1 year, within 1 year.
1 year, or the operating cycle, whichever is longer. Yesterday we saw that operating cycle. See, cash is invested into raw material. Raw material gets converted to finished goods. Finished goods, when they are sold, um, the amount of cash is realized back. But if they are sold on credit basis, it would get converted to accounts receivable. At the end of the period, cash is received. So this is the operating cycle. See, either it is 1 year or it is operating cycle, whichever is longer, because heavy industries take a longer period of time for the production to be completed and the amount of cash to receive. See, it requires a longer period of time. So either it is 1 year or operating cycle, whichever is longer, fine. So under current assets, what do we have? We have cash, cash in hand, cash and near cash, like cash in hand, cash at bank, marketable securities. See, there's not much to do with cash balances. It would be same if it is cash at bank, slightly it increases, but there's nothing that we need to learn about how to value cash items. Then we have receivables. One adjustment we've done. Of course, receivables is a very big topic. You will be learning about these things when you study financial management at that time, F9, that is F9. So in detail, you will learn about what are the credit policies that are adopted. Many details about that you will learn. But right now, the only one adjustment is given as part of FA. That is how to deal with trade discount and cash discount. What is the accounting treatment? Then inventory also, we just learned two methods. One is FIFO method and one is weighted average method. So current assets is taken care of. Apart from that, we also have prepaid expenses, short-term investment, short-term advances, etc. Okay, that is not see, prepaid expenses would not be valued, or there is nothing, no change would be there. Prepaid expenses, you would receive benefit out of those expenses in the future. So therefore, the current assets category is done. Now comes non-current assets. Under non-current assets, the first category is property, plant and equipment, which is in tangible form. Tangible form, how to value that, what is how is depreciation calculated, how do we revalue the assets to adjust it according to the market value. But then we also have under fixed assets, it's a broad term about fixed assets or non-current assets, which includes property, plant, equipment, intangible assets, and any type of investments that are made in other businesses. All of them are part of non-current assets. Intangible assets. Intangible assets which do not have that physical form. Okay, the benefit that is derived is for a longer period of time. Therefore, they are non-current in nature, more than 1 year, non-current in nature, but there is no physical form of those assets. What's the accounting treatment? Treatment wise, if we look into that. Okay. So if they are non-current assets and also intangible assets, so then there's no physical substance, may be purchased or internally generated. Now, is depreciation provided on that? The treatment of depreciation, the way the asset is written off, the value of the asset is brought down to adjust it to the market value. The amount of depreciation charged is the same thing. Treatment wise, it is the same thing, but the term is different. In case of tangible non-current assets, when the asset value is written down, we call that to be as depreciation. In case of intangible assets, when the asset value is written down, we call that to be as amortization. These are the terms. In case if the asset is a natural resource like a mine or a quarry or oil well or something, and the resources are extracted out of that, so the value is reduced because the benefit is already derived. So to that extent, any amount that has to be written down is referred to as depletion, DPLE, depletion. Okay. In case of intangible assets, the treatment wise, it's the same thing. Whatever is the method that is adopted, the cost of the intangible asset is spread over the life of the asset, right? But we refer that particular thing with a term called as amortization. Amortization reflects consumption of the asset. Now, what are the examples of intangible assets? When there is no physical form, why are we calling it as an asset? There is nothing that can be seen. Because of the economic benefit that can be derived out of those assets, we term them economic benefit that can be derived out of these transactions, we refer them to be as assets, and the benefit can be derived for a longer period of time, therefore they fall under non-current assets. In case of receivables also, there is no physical form, but the benefit is for a short period of time. In the next period it would be realized, the economic benefit can be realized. That is also intangible in nature, but it falls under current assets. The criteria is the time period. The benefit out of this can be derived for a very long period of time. Like we have development costs, goodwill, trademarks, licenses and patents, technical know-how, copyrights, all these are examples of intangible assets. Treatment wise, we charge a part of the assets to the profit and loss account income statement, but the term which is used is called as amortization. Research and development costs. So research and development costs are incurred at the beginning of the life cycle of the organization. At that time, research and development costs are incurred. Now, to determine whether an internally generated intangible asset meets the criteria for recognition, should it be accounted as an asset? So now there's no physical substance for research and development, R&D cost, there is no such thing. So should it be accounted as an asset or not? Should it be recognized? Now the criteria here is how long the benefit would be realized out of research and development is not certain. Out of this, the benefit, what is the life of the benefit that can be realized is not certain, because for a very long period of time, the benefit out of that is I'm not able to. Okay, the benefit that is realized is for a very long period of time. So now, what is the treatment for this one? So for the research expenditure, since the life is indefinite period of time, the original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. That's the meaning of research expenditure. Life is in indefinite period of time. So how long would this be spread for is not known. Therefore, the accounting treatment is the entire amount of research expenditure that is incurred in any period is expensed in the same period. The total amount is deducted in the same year as an expense. Nothing is capitalized. If it is capitalized, that amount will appear in the balance sheet, like these items, trademarks, licenses, patents, etc. So as they appear in the balance sheet on the asset side, research expenses also would appear, but the very fact that we do not know for how long the benefit would be realized, it's an indefinite period of time. So the accounting treatment is that the research amount, whatever is spent in any year, the total amount will be shown as an expense, research expense, and charged to the income statement. It is expensed as it is incurred. It is not capitalized. It would not go to the asset side of the balance sheet. Whereas in case of development expenditure, the application of research finding or other knowledge to a plan or design for the production of, we see that new substantially improved materials, devices, etc. before the start of the commercial production or use. So it enhances the production ability of the business. So some the criteria is considered, and the time period for which the benefit that can be realized is decided. and the development expenditure will be spread over that long period. Development expenditure is capitalized. It is shown as part of the assets, intangible assets, but research amount, because of research, if there are any expenses that are incurred, they would be shown in the income statement, expensed as it is incurred. But not so with development expenditure. That is spread over the life of that, and the amount of development expenditure is capitalized. It will be appearing as a non-current intangible asset. When you study FR, financial reporting, see all these things will be repeated, but in detail, very specifically with each item, you will learn about that. That's as part of financial reporting. How would these elements of financial statements be reported? Now here, this is just the basic level knowledge. This is the foundation level. So you just learn these terms. Of course, it's an exemption paper, but still this becomes the base for your FR paper later on. You will also do SBR. So those are compulsory papers. So at that time, this basic knowledge, whatever you learn at this point of time, becomes useful for you to apply it there. Okay. Development expenditure. How to decide whether it is considered as development expenditure so that it can be considered for capitalization or capitalized amount recorded on the asset side. It should meet the following criteria. The expenditure is incurred on a separate project. It's not in general that some expenses are incurred, but it is specific to a project. Expenditure identifiable and reliably measured, commercially viable, technically feasible, overall profitable, resource available to complete the project. So then the life will be associated with the project. As long as the project is there, the development expenses also will be spread over for that long period. It should be identifiable. It should be identified with the project or with the cost object. It is identifiable. So it will be associated, it would be related to that particular cost object. Expenditure is identifiable and reliably measured, specifically incurred for a purpose that should be known. If that identifiability is there, then it will be treated as a capitalized amount. It should be commercially viable. Because of this, there is a benefit possible to be realized, that is commercially viable. It should also be possible for them to spend that. Technically, it should be feasible. Overall, there should be some benefit out of that. It is not that some amount is incurred and what is the benefit, when, how long is the benefit, when would the benefit be realized. If those things are not sure about it, then it will not fall on that category of development expenditure. It will be expensed whenever it is incurred. It would be expensed in the year. But if it is very clearly identifiable with some activity, some cost object, then it would be treated as development expenditure and it can be capitalized. It should be overall profitable and resources are available to complete the project. Then in that case, this will appear on the asset side of the balance sheet. Accruals or prepayments. Payments made in advance is prepaid expenses. Okay. Accruals and prepayments. Accrual concept. We see that. Income and expenditure should be accounted for in the period in which it relates, not when cash is received or paid. We already know that part of it. If the transaction relates to a current period, whether the cash settlement was made or not, it is accounted. If there is anything which relates to the next period, it will be not accounted in the current year's income statement, but it would be treated as an item of asset if it is paid in advance. Paid in advance, the expenditure is already made, but the benefit is not yet realized. Let's say if there is an advance tax paid, so the next period, to that extent, tax amount need not be paid. If there is prepaid rent, the benefit of utilizing the accommodation would be there without making a payment. Benefit is still there. So benefit is not yet realized. On that note, it will be shown as an asset because it is for a short period of time. It would appear as an asset. So if it is prepaid expenses, okay. What if it is not settled? If it is outstanding, so then there would be a liability to settle that. So that will be for a short period of time. Within short period of time, it would be discharged. It appears on the current liabilities on the liability side. Income, if it is received in advance, income is received, amount is received, but the liability to discharge the service or deliver the product has not yet taken place. Until the time the products are delivered or the services are rendered, that portion of the income will appear as a liability. If income is outstanding, they have the right to collect it, therefore it is an asset. Okay, so accruals and prepayments, what's the accounting treatment? Where would we write them, on asset side or liability side? Depends on whether there is any economic benefit to be realized out of that. If it is so, then it will appear on the asset side. Economic benefit would be in terms of amount to be collected in future, or the benefit of those services to be realized, and that note it will be an asset. If there is any kind of a liability which arises to pay off the amount or provide the products or services, on that note it will appear as a liability. These are all for short period of time, so they appear on the current asset side or current liabilities of the balance of the liability side. Into journal entries, accrued expenditure, expenses accrued, expenses charged against profits for the period, even though they have not yet been paid. So expenses is debited for the current period, but there's no cash payment made. So there is an accrual. Accrual is the representative personal account. So something like the entity is a giver, so it appears as an accrual, outstanding amount, outstanding liability, or whatever is a specific term, that would be credited. If it is prepaid, prepayment is a benefit that is already realized. The payment is already made, but the benefit is not yet realized. So the payment is made as against the expenses. When the amount is paid, the journal entry would be the total amount of expenses versus to cash. But all expenses are not related to the current period. So that portion of expenses which relate to the next period is deducted. So that is credited, and prepaid is an asset. It is debited. Prepaid expenses debited to expenses account. That is an adjustment to the expense. Pro forma of expenses account. This is basic. The expenses is a debit item, debit all expenses and losses. So it will have an opening balance on the debit side. So the beginning balance brought down is on the debit side. Any additional expenses that were paid is accounted for. Then we see that anything that is accrued, opening balance of anything that is accrued is credited. Outstanding expenses, the liability which has to be settled. Okay, so closing accrued expenses, everything is accounted in the same expenses account, but we can also have a separate account for expenses separately. We can have an account separately for accrued expenses. So accrued is a liability, therefore liability will have an opening credit balance. This is all clubbed into one account and then we see that. But preferably we can have two separate accounts called as an expenses account and then accrued expenses account. Accrued expenses is a liability, therefore it will have an opening credit balance. Separate it and see whatever is the settlement that is made during the period, whatever are the additional expenses that are paid. Okay, then this and this will come in one case, and this is bank expenses. These two appear in accrued expenses. So any kind of a settlement that is made is accounted for. This is a T form of expenses account. Separate it and then prepare those things. In case of income, accrued and prepaid income, same is the explanation. If the income is accrued, it is outstanding income or income not received, but it is income of the current period. So income account is credited. Accrued income is a benefit that will be realized in the next period. Okay. Accrued income is debited. On account of accrued income, the economic benefit will be realized in the next period. On that note, it is debited. It is an asset. Prepaid income. Income is received in advance. So when the amount is received, the entry would be cash to income, but that portion of income is not related to the current period. It has to be deducted, and therefore income account is debited to adjust the income amount related to the current period. So income is debited. The additional income that is received relates to the next period until the time that the whatever are the benefits that are to be provided in terms of goods or services, until the time those things are provided, it will appear as a liability. Okay, liability to discharge the goods or services. So it is credited, prepaid income. This is the T form of income account. Receivables. What are receivables? Receivables, the right to receive the amount from the customers because a trade activity or sale activity has taken place. With respect to receivables, we see that there is a possibility of the customers not receivables would be the customers to whom goods are sold on credit basis will make the payment on a future date. At the end of the credit period that is extended to the customer, at the end of the period, the customer makes the payment. But there is always a risk that is present that the customers may fail to make the payment. The customer does not pay the amount. So it could be because he is unable to make the payment. Maybe the customer must have become bankrupt that he is not able to pay. But otherwise, all measures would be taken to collect the amount from the customers. It's just not that they are left like that. The any efforts to remind the customers, communication would be sent. There are collection agents who would visit the customer to collect that. All those efforts would be put in. In spite of that, sometimes the customers may become bankrupt. There's no possible way that the amount can be recovered from the customers. So such dues or such receivables, due amounts that are to be collected from the customers are treated as bad debts, debt that has become bad. It is absolutely irrecoverable. It cannot be collected. So if it is an irrecoverable debt or a bad debt, it is a loss for the business. So prudence principle, what does it say? Conservatism, prudence, what does it say?
Assume all the losses beforehand, but not the income.
Yeah, account for any future losses that are anticipated, but not for future gains. So in the business, if they have the policy of selling goods on credit basis to the customers, so they must have observed that in the market, normally some percentage of the amount is irrecoverable. So generally by observation as to what is the practice of how to what percentage of the amounts are usually recovered, what is not recovered, they might be observing that. So that may be in the industry, among the peers, for the business entity, for the business organization, everywhere the some percentage is a loss that is incurred on account of irrecoverable debts. So when such a thing is known, it is anticipated. Estimated amount of bad debts is some percentage, like say 2%, 3%, or 5%, something like that. That is what is happening over a period of time in that industry. So that is an anticipated loss for which there can be a provision allowed to be created. Okay, so they are allowed, the business entities allowed to provide for the future losses by setting aside some amount of profit in case if there is a loss that happens, that provision or that allowance that is set aside from the profit of the current year will be used to meet the future losses that arise on account of irrecoverable debts. So this is with respect to trade receivables. So trade receivables, there is a possibility of bad debts happening, and because bad debts happen at some percentage, anticipated percentage, if it is known, to that extent, the business is allowed to make an allowance, to make a provision, that is to set aside the current year's profit. Some amount is set aside to meet that future loss. That is allowances for receivables. Cash sales journal entry, we know sales is always credited and cash is received, debit what comes in, cash account data to sales revenue. If it is credit sales, it would be in place of cash, it will be receivables, receivables account data to revenue, sales revenue. Okay. The day when cash is collected, receivables account will be closed. Cash to receivables. But if the total amount is collected, then cash to receivables is justifiable. But if let's say that the total amount of receivables as against that cash is not received, a portion of it becomes bad debts. An irrecoverable debt is a debt which is or considered to be uncollectible. It must be removed from receivables and written off as an expense. So here, so to that extent of amount which is irrecoverable, it will be debited, debit or losses. So the loss is accounted, bad debts or irrecoverable debt expenses. To now receivables will now no longer be collected to that extent. It is credited and the account is closed. Let's say in this current period, or let's say last period, there was some amount of bad debts accounted as a loss. Receivables is also closed. The account is closed. The loss is accounted for and things are all settled. Now in the current period, assume that whatever was closed in the last period, if those customers come back and make the payment, now the account is no longer existing. The account is not existing because receivables is closed. To that extent, whatever is not recoverable, to the extent what cash is received. So on that note, not received, settled as a loss, receivables is closed. So when the customer comes back and makes the payment, there is some amount of bad debt which is recovered. So in this case, Okay. In this case, since there is no receivables account, we cannot bring into picture receivables account. Because the customer is paying back, cash is coming in, the journal entry will have cash account, debit what comes in. Now a new account will be created called as irrecoverable debt expenses account. So there is a new account, new entry which is passed. It would now not be on account of receivables. Receivables is no longer in existence. So bad debts, whatever was debited, that bad debts to that extent it is adjusted, that loss is brought down. Okay. So irrecoverable debt expenses is credited. So journal entry will not have receivables. Journal entry will have cash because it is coming in, debit what comes in. And this is to nullify the loss account that was created in the previous period, adjusting that. So canceling it off. So irrecoverable debt expenses account is credited. Okay, that's the journal entry. Journal entry wise, you have to remember. No, I mean, why are we looking into all these things? Generally, finance students, when they go for placements, in the placements, finance interviews, what is the procedure that happens? There would be multiple technical rounds. The initial, maybe whatever is the round that is cleared, the students will go through different rounds. Now, each one would be proficient in their field. Most of the time, they are chartered accountants sitting there to conduct the interviews. So they come out with all these kind of journal entries. So they have definitely they have strong accounting background, and the testing would go in terms of what comes up at that point of time. Nobody knows, and then you should be clear with the logic to answer those questions. So that's why you have to run through all this information. Though it is an exempted paper, please have this strong accounting knowledge about the transactions. Remember that initial rounds will start with journal entries only. Journal entries, accounting treatment, accounting principles. As you go ahead in these technical rounds, then they focus on other areas, other advanced finance areas. They focus on that, but the initial rounds are all with these kind of journal entries. So you should remember them. The logic wise, you should be very strong with that. Okay, sometimes they also confuse you. Are you sure? Are you sure? Then you should say that you are really sure about that. Okay. So what's this concept of setting aside, providing an allowance per receivable? Because it is an anticipated loss, the business entity is allowed to provide a future for an estimated future loss. Where the recoverability of a receivable is uncertain, an allowance may be set up to reflect this to apply the concept of prudence. The allowance will be offset against the receivables balance in the statement of financial position. So let's look at what is the accounting treatment. So there is an allowance account that is created. Setting up an allowance, allowance is for receivables on account of anticipated irrecoverable bad debt. So it's treated as a loss, and this the current period's profit is set aside. That is allowance for receivables. Any additional allowance that has to be created, the same journal entry, additional allowance that is created, irrecoverable debt expenses to allowance for receivable. If the already there is some allowance that is created earlier, but bad debts to that extent did not take place, if the balance has to be reduced, decrease in the allowance, reverse the entry. Time permits, I am not very sure because my allotted time is only 20 hours. One full paper to do in 20 hours. This is the pace at which I can go and then explain only that. Numerical questions, if time permits, I will take up at least 3 journal entries. We can write about how to create allowances for receivables. But I'm not sure. I don't think I will get time to take it up. If I get time, I will definitely take it up. Okay. So moving ahead, come to the liabilities side, payables, provisions, and contingent liabilities. What is a liability? Liability is an obligation to transfer economic benefit as a result of past transactions or events. So there is an obligation to settle that because some transaction has taken place in the past. So the obligation to settle that in terms of transferring an economic benefit, we call that to be as a liability. See the categories of um, on the balance sheet. See, I'm just presenting it in the T form, but it is a vertical format that is followed when balance sheets are prepared. Of late, we see that they are prepared in the vertical format, but this is easy for us to understand. Therefore, I always put this T form of it on one side assets, one side liabilities. So on the liability side, if we talk about on the liability side, the broad classification of liabilities, we have the liabilities as current liabilities. The same type of definition, liability that has to be discharged in a period of 1 year or operating cycle, whichever is longer, is called as a current liability. After that, we see the heading is long-term liabilities. Okay, long-term liabilities. If the liability that has to be settled to outsiders and the time period is a long period, that is which is more than 1 year, we categorize them as long-term liabilities. If the liability is to the owners, we call that to be as equity. This is on the liability side. Okay. Current versus non-current liabilities. Liabilities of uncertain timing and amount. Apart from that, there are liabilities that would arise, but when would they arise is not sure. So under that category, we see that there's one thing called as provision and another thing called as contingent liability. Liability which would arise in the future is a contingent liability. So the purpose is known, specific purpose is known, but as of now there is no liability, but there is a possibility that it may arise in the future. So if that is the case, contingent liability to that extent, amount can be set aside and it would appear on the balance sheet. So contingent liability. See, under equity is the liability to the owners. So liability basically, equity basically, what would we have under equity? See the amount of capital that is contributed in case of a company, the amount of capital that is contributed, we call it as the share capital. So anything about the share capital, any premium amount, all of them would be there. Each period, whatever is the net profit that is earned, that belongs to the owner, that belongs to the shareholders. So part of it is distributed as dividends. Generally, a part of it is retained in the business. Why? Because any liability that arises can be met out of that retained profits, or to meet any requirement in terms of additional investment, etc. For that reason, a portion of the profits are retained in the business. I'll just put one. The other day we were looking at income statement format. Once again, I will put that here on the screen. We'll just look at that income statement format and then we'll discuss about it. 1 second. Do you have college tomorrow?
We do, ma'am.
Oh,
Ma'am, we do, I guess.
oh, all 6 days.
Yeah, including Saturday. Yeah.
Mm. Is the schedule hectic?
Tomorrow it's not scheduled hectic, but well, some of the groups might have had, some of the clubs might have meetings, so we'll have to see.
Oh,
Saturday is more of extracurricular days.
okay. It's a little relaxing, I guess.
Yeah, it's little off in that.
It's taking time to open that income statement format. Okay. So this is the format of income statement. We were talking about contingent liabilities that may arise. The income statement format is a simple format. So the first part of it is sales minus cost of goods sold, gross profit, operating expenses, operating profit, any kind of a non-operating expenses incomes adjusted. And this is the profit at this point of time. This is the profit available to all the investors. Investors, some of them are owners, that is shareholders. Some of them are outsiders like debt holders. Different types of debts, debt categories of debts are there. Out of that, the first preference is given to the outsiders. So interest is paid to them. Then the balance of it is called as EBT, earnings before tax, liability settled. Then out of the categories of preference share capital, I don't know whether you are aware of that, but let's say that there are two types of share capital. First, dividend is paid, or the return which is paid on share capital is called as dividend. First preference is given to the preference shareholders, so preferred dividend is paid first. Balance of it, all this entire amount of profit that is available here, it belongs to the ordinary equity shareholders. It belongs to them. The company can take a decision of distributing the entire amount to them, or a part of it is distributed, the rest of it is retained in the business as retained earnings. What's the reason? The reason is, if in case any liability that arises in future, those liabilities can be met out of retained earnings. That's one reason. Or if additional investment requirements arise in future, the additional investment can be met out of retained earnings. So it's a practice that out of the profit, some amount of profit is set aside to meet future purposes. Any kind of a liability that arises, or any kind of a expense loss that arises, that can be met out of the amount of profit that is set aside, that allowance that is set aside. The terms that are used here, amount of profit set aside, is provision, reserve, allowance. All these are the terms. Of course, specific, intricately, each one of them has a very, very specific purpose, specific meaning to that. But in general, at this point of time, any profit which is not distributed to the shareholders, but if it is set aside, it actually belongs to that amount of profit belongs to the shareholders. But right now, in the current period, that is set aside, because in future they may require this amount to settle something, to meet an expense or to meet a liability, anything that may come up in the future to meet that. If the profit is retained in the business, it is set aside. It should actually be distributed. But normally that's the practice, that they do not distribute 100% of the profits to the shareholders. That belongs to them, but it is not distributed. Eventually it will be paid to the shareholders, but it is not paid in the current year. That's the only point of it. So the amount of profit that is retained in the business, in general, if it is retained, we call it as retained earnings. But if the purpose is specific or anything that is anticipated, then we call that to be as provisions. Provisions, the purpose is specific why the amount is set aside. The reserve, no purpose is known as of now, but amount is set aside to meet anything that may arise in the future. So profits are set aside to meet future expenses or liabilities, or as of now there is no liability, but it is anticipated it may come up in the future. Suppose there is a business, yeah.
Ma'am, I don't know, but your voice is coming low for me.
Is it the same with others? I will change the internet connection if it is so. Others, please respond. Is my voice low?
No, this side, ma'am.
Is it the same? No, I didn't get you. Sorry. Is it low?
No, ma'am, not
No.
from my side.
Okay. Maybe the signal strength is low for you. Move to a place in your house where the signal strength may be strong.
Okay, ma'am.
Yeah. Okay. So, for example, let's say that maybe there is an equipment which is being used by a business. There is a life of that equipment. At the end of the life of the equipment, it cannot be discarded as it is, but maybe that has to be done something with that, maybe dismantle that, was something has to be taken up. As of now, it is being used in the business. As it is used. But after a while, let's say 4 or 5 years later, when the life expires, there is a liability that will arise at that point of time. So that is a contingent liability. Right now, there is no liability that they have to settle, but some of them are foreseen to be arising in the future. So for that, any amount that is set aside is a contingent liability. Right now, it is not liability. It would arise in the future. Okay. Liabilities of uncertain timing and the amount. To what extent would that liability be is uncertain, or when would the liability arise? That is also sometimes it's not sure, but some profit is set aside. Profit that is set aside to meet the future liabilities or obligations. We call them as contingent liabilities. The way we were talking about receivables, so payables also have to be discussed. If the purchases are on cash basis, purchase is always debited as against cash which is going out. If cash is not going out, it should be credited with the representative personal account, who's the supplier. Supplier's name would be accounted as a payable. So he's the giver of the goods, therefore it is credited. Okay, purchases account. If it is a credit purchase, purchases account returned to payable. When the liability is settled, payable to cash. So we've already discussed yesterday, I think yesterday, day before yesterday, we did discuss about what if there is a discount given by the supplier as a cash discount, if discount is received from the supplier side. So the settlement would be payables amount, cash amount to discount received amount. Okay, received account. Okay, so what's a provision? Provision is any amount of profit that is set aside. Provision is a liability of uncertain timing and or amount which would arise in the future. So some amount of profit that is set aside. Accounting for a provision is achieved by making a reliable estimate of the cost to settle the liability and recognizing it immediately. So when it appears, this would be met out of the amount of provision which is already set aside. So recognition of a provision as per IAS standard 37. The when is the transaction set to be recognized? So that's another topic which has to be discussed. When is the transaction set to be recognized? There are three criteria that must be satisfied. An entity has a present obligation, legal or constructive, as a result of the past event. So when is the transaction set to be recognized? We would be looking into transaction recognized with respect to revenue, with respect to expenses, here with respect to provision. Recognition of a provision. The 3 points that are to be considered. First one, an entity has a present obligation as a result of past event, or it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. So it is a possibility. It is not sure about what would be the outflow. It is a possibility that there would be some outflow on account of some transaction that has to be settled. The third situation is a reliable estimate can be made of the amount of the obligation. Something is possible to be estimated. If these three things are satisfied, the provision can be set aside. So that is, they should be able to anticipate something about that transaction for the future period. Then anything very specifically set aside is called as provision. The difference between provision and a reserve, the purpose is known. The entity has a present obligation because of something that has happened. It's very specific. Or the possibility, the probability that there would be an outflow on account of something. Or it is possible to estimate some amount for a particular obligation. Purpose is specific, it is known. It may not be with certainty what is the amount is not known, but probability of happening of that event is anticipated. Okay, then in that case, provision can be set aside. If the purpose is not known, but still the profit is set aside, we call that to be as a reserve. Contingent liability, a possible obligation that arises from past events and whose existence will be confirmed only when the event occurs. It may occur, it may not occur, but it is possible to occur in the future. But how do we know what is the to what extent is the liability? Only when it occurs, it would be known. Occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. Okay. Something that has to be settled, but to what extent the amount would be settled or when would it be settled, those things are not certain. That is a contingent liability. A contingent liability may be a present obligation that arises from a past event, but it's not recognized because it is not probable that an outflow of resources would be there, or the amount of obligation cannot be measured. What is the amount is not known, How much is the amount would not be known. What is the probability that there would be? To what extent would there be a outflow of funds is not known. Okay. The amount of obligations cannot be measured. How much would also is not known. This you know about contingent liabilities. What is a contingent asset? There is a possibility that there is a benefit that can be anticipated because of past events, contingent assets.
Sir, ma'am, can you please give me an example of contingent asset? Because the other definition I understood, but still.
I'm also not able to recollect anything. Some benefit which is anticipated. What example? Not very sure about it. Let me get back to you on
Ma'am,
that.
can it be some kind of loan that we have given off to the person? Interest.
Interest is no, it is sure because the terms and conditions are fixed. So interest that is received is an income.
Ma'am,
That is
if it's a doubtful debtor, then
doubtful debt if it is going to be received, anticipated to be received. But it's already settled. But if it is anticipated that it may be settled, okay, that yes, that can be a contingent asset. Maybe because some dispute is going on, as against that it is already written off as a loss, but it is anticipated that it can be recovered
or some court case.
on a positive verdict. It is possible to be received, but it may not be sure about how much and to what extent it would be received. Yes, that could be a possibility.
Sure. Thank you.
All future anticipated losses are to be provided, but not future benefits. So we have that prudence thing. So the probability of occurrence is greater than 95%. It is provided between 51 to 95%. It is provided possible that 5% to 50%. Also, the details are mentioned that it is possible to be recognized. Additional information talks about the possibility of future loss happening. It is disclosed in the financial statement. If the chance of happening is very remote or less than 5%, it is ignored. In case if it is very certain that it would be recognized, let's say that there is an insurance claim, something which is anticipated that as an insurance claim it would be received. So insurance claim is a receivable. It is an but when would it be settled if it is not sure? So that would arise in future with certainty that it is known at least greater than 95%. If it is there, recognize that. Anything between 51 and 9, because the prudence law says that don't anticipate anything in terms of gain. So do not account for that. Any benefit that is to be received in future, only when it is certain, that then only it is accounted as an asset. Okay. If it is between 51 to 95%, in the notes to financial statement, it is recorded. Other than that, less than 50%, it is not recorded. When it happens, it would be recorded because anticipate no future gain. So anything less than 50%, it is completely ignored. Okay, we have 13 minutes time. I'll just briefly talk about the capital structure. We will continue on Monday. So on the liability side, already we just saw that the liabilities are categorized as current liabilities. Then we have the long-term liabilities, but then they are again categorized as the liability to the outsider, which is called as debt or long-term liabilities. And we have the equity. So The point of difference between these two is, one is to the outsiders, the liability to the outsiders is long-term liabilities or debt. There are different types of debt. Debt raised from any source, for which there are certain terms and conditions, like there is a fixed percentage of return that has to be paid irrespective of the profitability. There is a time period, tenure, at the end of it, the debt amount has to be repaid, redeemed. Okay. Equity, there are no such obligations as to pay a fixed dividend. Just in some time back, we just saw the income statement format. There is some amount of retained earnings. There are situations where companies also take decisions of retaining 100% of the profits. We see that situation also. Of course, there are so many consequences if companies go in for deciding on retaining 100% of the profit, but technically there is no such obligation that has to be met on share capital to pay dividend. When profits are available, dividends are paid. When no profits are available, no dividends are paid. The company is under no obligation to make the payment to shareholders as dividend. Okay. Now we look into capital structure and finance cost. So capital structure and finance cost, when we talk about cost of capital, basically we talk about. There are attributes associated with debt capital and equity capital. So if we have debt and equity, debt is outsiders, equity is owners. The cost that is paid on debt capital, debt is a cheaper form of capital. Cost is low. Equity cost is high. There's another attribute which is risk. Risk in case of debt capital, it is high. And equity capital, risk is low. So we see that there is one advantage and one disadvantage kind of thing. So ideally speaking, the capital structure of a company should be in equal proportion, 1:1, ideally speaking. Of course, not everybody follows that because of various objectives of the organization to maximize their profit or to play safe or to be safe, something like that. Then they take their own decisions. But ideally speaking, the capital structure should be in equal proportion. Why do we call that the cost on debt capital is low? The debt capital on that, the return that is paid on debt capital is called as interest. Interest is paid. Interest would be at a rate, the rate of interest would be at the time of issue, whatever is the rate prevailing, that would be the rate of interest applicable throughout the life of the debt capital. Let's say if it is for 20 years, the same rate will apply for 20 years. 10 years, same rate will apply for 10 years. That's one thing. So over a period of time, when we talk about, because as the time passes by, the interest rates also increase, but there would be no such changes accommodated for interest. That's one reason. Second most important reason is, whatever is the interest amount paid, it is tax deductible. So what does it mean by tax deductible? I'll just put the income statement format one more time. What does it mean? See, after interest is paid, by paying the interest, the profit is reduced. This is the profit that is available to all investors. After interest is paid, the profit is reduced. On the reduced profit, tax is calculated. So because of interest payment, there is some benefit received in terms of payment of tax. So it is called as tax deductible expense. Interest is a tax deductible expense. So that's the benefit what can be derived in terms of debt capital. Okay. Got it. So we have debt and equity. So in terms of debt, cost is lower. Cost is lower in case of debt capital, but no such thing is there in case of debt. In case of equity, equity cost is higher. I'll come, I'll come to this cost is higher part of it, but the second attribute, risk is high in case of debt. See, it is though it is tax deductible cost or whatever it is, see, irrespective of whether there is a profit made by the business or not, interest has to be paid. It is an obligation, fixed obligation. Plus, there is a maturity period. See, at the end of the maturity period, the total amount has to be repaid back to the debt holders. See, funds would not be available in the business because they're already invested into assets. So then to repay this amount of debt capital at the end of the life, again, they have to raise another source of finance. So there is an obligation to settle this. There is an obligation to settle these amounts, that is interest amount and the maturity amount. So risk is high. No such obligation in case of equity capital. When profits are available, only dividends are paid. Sometimes they are not paid also. Then there is no maturity period. Share capital is irredeemable. All of us know. As long as the company exists, the amounts are with the company. Company has absolutely no obligation to pay back the share capital. Of course, there is another situation, maybe some time when the time comes, you will know about it, called as buyback of shares. Company only buys back its shares. That's a different situation altogether. But as such, there's no obligation. There is no obligation to settle that. But the shareholders always have an expectation that the company earns better returns for them. They always have this expectation. If their expectation is not met, what action do they take? If their expectations are not met, they sell away their shares in the stock market, they withdraw their investment. I don't know whether you know how the stock market works. Stock market works as an exception to law of demand. When the demand falls, the prices also fall. When the demand rises, the prices rise. That is how the stock market works. If some of the shareholders are selling away their shares, so that is the information that is passed on in the stock market, and then that would be reflected in the fall in the prices of the shares, which is a negative thing for the company. So the company always has, the management of the company is always under a pressure to satisfy the shareholders, the equity holders. One of the objectives of financial management is, the objective of financial management is to maximize the wealth of the shareholders, satisfy them by maximizing the wealth of the shareholders. So they cannot afford to displease the shareholders. So the expectations to meet the expectation of the equity holders, company is under an obligation to earn better returns, whether it is paid in the current year or in the future period. The overall cost of equity capital is higher than debt capital. If they are not satisfied, the consequences are negative. Therefore, cost, technically speaking, there's no obligation, risk is low. But this is, see, it is not explicitly, it is expected, but it is implicit. It is expectation from them. If that is not met, the impact would be seen in the stock market in terms of share prices. If the share prices fall, that's a negative thing, and other stakeholders also will not be associated with the company, and that will have a very negative impact in the market. So now that we see that there are certain points that are, see, one aspect is positive, one aspect is negative. To balance that, the capital structure should be such that equal proportion of debt capital and equity capital should be raised and employed in the company. Okay, so that is what we will be looking into from Monday onwards. So we will be talking about how they are valued at journal entries, etc. Other parts also we will discuss about it related to debt capital and equity capital. Is that fine? Any doubts?
No, ma'am.
Okay. Let's close this. I should be taking attendance, but I am not stopping. I'll take it from Zoom. The strength is 12, you said, isn't it? Strength of the class is 12, isn't it? You're also
Don't know,
not
ma'am.
sure? Don't know. Okay, no problem. I'll do it from the Zoom account. I'll take the attendance and mark it. Okay, I'll meet you
Yes,
again.
ma'am.
Yes, ma'am.
You said you'd tell us about how to access the previous year report.
Um, the website name is accaglobal.org. You click on that, then it will take you to the site. There you need to click on foundational papers. Under foundational papers is FA3, no? FA3, click on that, and they Monday at the beginning only. Will you remind me? I'm really sorry about that, but Monday I will definitely show it to you how to
Okay, ma'am.
download them. Okay, please
Okay.
remind me.
Yes.
We will see how to download that and then proceed further. Okay, exam kit. Your names are not added in LMS. That is what I got to know. But I think they will be very soon added. All your details will be included, and then a group will be created on LMS. Since you are not there on LMS, I cannot show from where you would do that. But otherwise also I will show you how to access LMS and how to download from ACCA site. Monday I will definitely do. Okay.
Okay, ma'am. Thank you.
Okay. Today we'll end the session here.
Thank you, ma'am.
Good night.
Thank you, ma'am. Good night.